So what is asset allocation? And more importantly, should you even care? Have you ever wondered why some people consistently grow their wealth while others struggle to build their portfolios? The secret often lies in one key concept: asset allocation. In today's market environment, it has never been more critical to truly understand asset allocation. In this video, I'm going to share with you exactly what asset allocation is, why it's crucial for your investing success, and share with you 3 real-life world examples of famous investors who have mastered the art of asset allocation. You'll learn how these legends think about their portfolios and how you can apply the same strategies to your portfolio. And here's something that just might surprise you. Studies show that up to 90% of a portfolio's returns come from asset allocation. Not stock picking, not market timing. Asset allocation. So stay tuned and please try as much as you can not to skip ahead, because I want you to understand each main point and concept. Asset allocation is the process of dividing your investment portfolio and separating it among different asset classes to balance risk and return. Think of it like building a pizza. Everything such as stocks, bonds, cash, alternative investments all represent a slice. The proportions depend upon your personal taste and preferences. So this could be your financial goals, your time horizon, or your risk tolerance. The main asset classes include 1. Stocks or equities. These are shares of a company. They're like the spicy topping, risky but full of flavor. Stocks often deliver the highest returns over time, but come with greater ups and downs. Number 2, bonds or fixed income. Bonds are loans to governments or corporations. Think of them like the cheese, steady, reliable, and smoothing out the overall flavor. Number 3, cash and cash equivalents. These are highly liquid assets like savings accounts or money market funds. They're like the crust, not flashy, but essential for structure and stability. Number 4, alternative investments. Think real estate, commodities, or even hedge funds. These are the specialty toppings, unique but not for everyone. In case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I've been investing for a number of years now, so I think it's safe to say I know my stuff. I talk about personal finance and investing. If that sounds like something you'd be interested in, consider subscribing to my channel. So why is asset allocation so important? Number 1, risk management. Different asset classes react differently to market changes. If one zigs, the other zags. For example, if stocks tumble, bonds might hold steady, reducing overall losses. For instance, during the 2020 market crash, a portfolio with 60% stocks and 40% bonds fell significantly less than an all-stock portfolio, demonstrating the power of proper asset allocation. Number 2, goal alignment. Asset allocation ensures that your portfolio aligns with what you're trying to achieve. Whether it's saving for retirement, buying a home, or growing wealth over decades, your allocation is the roadmap. Number 3, balancing risk and return. Younger investors can afford to have a more heavily weighted stock portfolio because they have time on their side, so they're able to recover better from market dips. Older investors nearing retirement often shift to more stable assets like bonds and cash. Factors that influence asset allocation. Number 1, risk tolerance, your ability to handle market volatility. An aggressive investor might allocate 80% to stocks, while a conservative investor might lean more towards bonds and cash. Number 2, time horizon. Exactly how long are you planning to invest that money, and when are you planning to withdraw it? A 30-year-old saving for retirement in 30 years has a much longer time horizon than someone retiring in 5 years. Number 3, financial goals. Are you aiming for growth, income, or stability? Each goal demands a different mix of assets. And as promised, here are 3 real-life world examples of asset allocation. Let's start with the granddaddy of them all, Warren Buffett, the CEO of Berkshire Hathaway. Buffett is famous in his simple yet powerful approach to asset allocation. He once said, "For most people, the best thing to do is to own a low-cost S&P 500 index fund." In his own personal portfolio, Warren keeps about 90% in stocks and 10% in cash and cash equivalents. Why such a heavy stock allocation? Buffett believes in the long-term growth potential of American business. He also is confident in his ability to endure short-term fluctuations because he understands the value of patience. For example, during the 2008 financial crisis, while many investors were panicking, Buffett was buying stocks. His high allocation to equities allowed him to capitalize on market opportunities, proving that his confidence in a stock-heavy portfolio is well-founded for long-term investors. Number 2 is Ray Dalio, the founder of Bridgewater Associates and one of the most successful hedge fund managers of all time. Dalio's asset allocation philosophy is built around his famous all-weather portfolio. Here's the story. In the 1990s, Dalio wanted to create a portfolio that could withstand any economic environment, whether it's inflation, deflation, or economic growth. The result? A portfolio allocated roughly as follows: 30% stocks, 40% long-term bonds, 15% intermediate-term bonds, 7.5% gold, 7.5% commodities. Dalio's philosophy is that different asset classes perform differently in different economic environments. For example, bonds tend to do well during deflationary periods, while gold shines during inflation. This diversified strategy smooths out returns and minimizes risk, making it ideal for investors seeking stability. Finally, number 3, let's look at Cathie Wood, CEO of ARK Invest. Wood is known for her bold bets on disruptive innovation. Her portfolios are heavily skewed towards high-growth tech stocks such as Tesla, Zoom, and Roku. Wood's asset allocation often looks like this: 70 to 80% in high-growth stocks, 10 to 15% in cash, 5 to 10% in alternative assets like cryptocurrencies. Why does she choose to do her allocation this way? Wood believes that technological innovations will drive exponential growth in the future. Her focus is on long-term trends like artificial intelligence, robotics, and genomics. While her strategy is high risk, it's also high reward. Her funds have seen incredible returns in bull markets, though they've experienced significant volatility. Hey, if you feel like you're getting something out of this video, would you do me a favor and hit the like button, as it helps out my channel? Much appreciated. Also, feel free to drop me a comment with whatever you want to say, even if it's just to say hi or what portfolio allocation you're going with. So how can you apply these strategies? What lessons can you learn from these portfolio allocations? Number 1, start with your goals. Are you trying to buy a house, saving for retirement, or just trying to learn about investing and grow your own portfolio? Your goal determines your mix of assets. Number 2, assess your risk tolerance. Be honest with yourself. Would you lose a lot of sleep if your portfolio suddenly dropped by 20%? If you're not so comfortable with that, lean more towards bonds and cash. Number 3, rebalance regularly. Your assets and your allocations will drift and move slowly over time as the market moves. Make sure to regularly rebalance your portfolio to align with your targets and financial goals. Now, I know this might seem like a lot to take in all at once. That's why I created the Ultimate Allocation Digital Package. I put together a comprehensive asset allocation blueprint package that includes ready-to-use portfolio templates for different risk levels, rebalancing worksheets and calculators, a step-by-step guide to implementing these strategies, and as a bonus, real-world case studies of successful portfolios. Just click the link in the description to get instant access to these resources. I priced them to be accessible for everyone who's serious about optimizing their investment strategy. Common asset allocation mistakes to avoid: over-concentrating in trendy sectors, neglecting international diversification, failing to compensate for age and risk tolerance, and finally, not rebalancing regularly. Asset allocation isn't just for the super wealthy and big guru investors like Buffett, Wood, and Dalio, but it's for everyday investors who are serious about growing their wealth. By understanding your goals, risk tolerance, and time horizon, you can create a portfolio that's tailored for you. And remember, whether you prefer Buffett's stock-heavy approach, Dalio's balanced strategy, or Wood's innovation focus, the key is to stay consistent and think long-term. Hey, if you feel like you're getting something out of this video, would you do me a favor and hit the like button, as it really helps out my channel? Much appreciated. Also, consider subscribing if you want to learn from a 20-year corporate accountant, analyst, and seasoned investor. If you're wanting more great videos on personal finance and investing, here are 2 that I highly recommend.